Good afternoon, everyone. Anthony Locke with Torrey Hills Capital. Welcome to the Cerrado Gold webcast for November 19th, 2025. Hope everyone's doing well, and thanks for taking the time to join our virtual lunch. Very excited to bring you Cerrado Gold. They are a Toronto-based precious metals mining and exploration company with three assets. The company's Minera Don Nicolas project is located in Argentina to producing gold and silver mine with significant optimization, expansion, and exploration potential. Company also holds an 80% interest in the highly prospective Lagoa Salgada VMS project in Portugal and 100% interest in the Mont Sorcier project located near Quebec. Company trades on the OTC under the ticker CRDOF and on the Venture under the ticker CERT, currently trading with a market cap of only about 135 million US. We feel the stock should benefit from the long-term positive outlooks for resources and the many positive investment catalysts that Mike will mention today on the webcast. With us today to discuss Cerrado Gold's operations and growth strategy going forward is the company's VP of Investor Relations, Mike McAllister. It's great to have you on, Mike, and thanks for taking the time to bring everyone up to speed on Cerrado Gold. Just before we get started, I think everybody knows the format. If you have a question, type it into the Q&A or chat box, and we will make sure that it gets answered. So with that said, I'm going to turn it over to Mike McAllister. Mike, the floor is yours.
Great. Thank you, everyone, for taking the time to hear the story today and hear the update. I'm hoping to get onto the road next year and come see you in person on a few of these lunches and be able to talk to you person to person. But so looking at Cerrado, we've continued to have a decent year. And just overall, we're a fully funded company, precious metal focused producer, but we do have some great critical mineral upside. We'll be making some forward-looking statements. So where is the company today? We're essentially a 55,000 ounce gold producer with the potential to grow over the next 3 years. And the potential to grow comes from the exploration programs that we're doing right now. We have a 20,000 meter surface program that's ongoing currently. However, we had some good success and we want to accelerate the program. So we've added an additional 3 drills and are bringing the lab for the results in-house. And so with that, we are planning 50,000 meters of drilling next year. And what's exciting is the drilling for next year also includes the very high-grade underground. And so that has the ability to not only ramp up what we'll be putting through in terms of production results, but also to extend the mine life to that 6 to 10 year time frame. And so we're very excited about that. Looking at this mine, at $2,100 gold, it cash flowed $50 million a year, free cash flow $25 million a year. Obviously, at 4,000, we'll just use that as a base gold price. We're seeing closer to 50 million free cash flow a year. So definitely strengthening the balance sheet and continuing to add cash to the balance sheet. Beyond our producing gold mine, we also have a near-term precious and critical mineral asset called Lagoa Salgada that's based on the Iberian Pyrite Belt in Portugal. This one here is a very important mine for us because not only is it a long mine life, 14 years, it has district scale discovery and exploration potential. So although it has a 14-year mine life on it, we know already that this is going to be a much longer mine life, even from our initial work that we've done on it. And I'll explain that a little bit more as we go forward. But with this one here, we're looking to be in a construction decision in the first quarter of next year and breaking ground in the second quarter of next year with production in 28. So this is coming online very quickly. Longer term, we also have a critical mineral opportunity, which is the Mont Sorcier iron ore project. And so a lot of people kind of yawn when they think of iron ore. However, this is not your regular iron ore. It's a very high grade, high purity green steel carbon reducing iron. It's 67%. Typically iron is at 62%, and even there's been some technical reports put out lately that the global average grade is dropping from 62 to 61, and they're seeing the impurities such as silica and alumina, which had been around that 2.5% level, starting to raise to about 4%. We're going to be producing 67% iron ore, which is a very high premium, and our silica and aluminum is below 2.5%. So our product is going to be in great demand, and with this, you get a much higher premium over the regular iron ore price, and the demand for this type of iron ore is growing at about 10% per annum versus 1 to 2% per annum for regular iron ore. That's at that 61, 62% level. So this is it's a direct reduction iron. It's a green steel transition project. It's located in Quebec. We're completing a bankable feasibility by the end of the second quarter, but we had already completed a PA on that, which just demonstrated an NPV of 1.6 billion. Excuse me. So we are well funded right now. We have 14.5 million in the bank, and with the free cash flow that we are seeing from the production, we expect, and as well as meeting all of our capital expenditures and expansion spending and resource spending, we still expect to see our cash balance grow closer to $20 million by the end of the year, as in addition to all the other payments that we're making. So we're very excited about that. We also have additional cash that we could see coming in through 5 million from an asset sale, which is guaranteed, and then another 10 million through an option agreement for a land package in the south of Argentina, which is not critical to our operations. Anglo is working on that right now, looking very good. So that's likely that that's going to come in as well. So that's another $15 million that will be added to the kitty. And so again, we're well funded for these high value projects. We don't expect to see any significant dilution, and we want to maximize value for shareholders. Just looking at the investment highlights, we've continued to grow the mine in Argentina, the Minera Don Nicolas asset. When we purchased this, it was in 2020. It was not producing at its rate. It was only producing about 16,000 ounces a year. We quickly ramped that up and have gotten that up to that 50 to 55,000 ounce level. We, as I mentioned, through exploration and through work that we're doing in the project, do expect to not only to be able to expand the production rates, but also to expand the mine life through these exploration programs that are currently underway. We are precious metal focused and will remain that way. Even bringing in the project in Portugal, the Lagoa Salgada project, we still will be a 62% precious metal focus. However, Lagoa Salgada also has critical minerals being zinc, copper, tin, and those are very much in demand in Europe. And so having a mine that produces them right in Europe, we've already, from initial offtake discussions, had significant interest from multiple offtakers wanting those minerals. So the value proposition for the company, the value for the proposition for the company, while you see a market cap of Canadian 188 million today, we have 14.5 million in the bank. We have 50 million on at today's gold prices coming in per year, free cash flow. We also have Portugal, which has an NPV of 146 million, which we're not getting any value for yet, and Quebec longer term, which has an NPV of 1.6 billion, which we're not getting any value for yet. So for an average share price of $1.39 Canadian, you're getting a significant amount of value that has not been priced into the story yet. Looking at this from a net asset value perspective, and again, these technical studies were done by third parties, and they were done at much lower metal prices than today, but just even conservative metal prices, this still looks good. So we start with 111 million of NAV at Lagoa Salgada, or sorry, at Minera Don Nicolas. You add in another 147 with Lagoa Salgada and 1.6 billion. So you have close to a 2 billion NAV by 2030, which is a very short time frame. To put it into easy perspective, if you're looking at this at a gold equivalent ounce, and although it's not all gold, it just gives you an understanding that we'd be going from 55,000 ounces currently to a similar to a 328,000 ounce producer in the next 4 to 5 years. So significant growth in a short period of time. Similar, if you're looking at the EBITDA or the cash flow, again, lower metal prices, they'd be much higher today. 44 million of cash flow coming from MDN, another bring that up to 12 million when you bring in Lagoa Salgada, and a huge amount, close to 500 million once we bring in Mont Sorcier. So again, you can see by 2030, a company that's producing conservatively $500 million annually of cash flow. This is a year of transition for the company. So right now at Minera Don Nicolas, we have our heap leach and underground production at 50,000 ounces a year. We believe that, and we know it's going to grow. You'll see a strong fourth quarter as we start to have the underground that we're mining coming in, as well as we continue to drill out and expand the underground. That should only bode well for further resource increases and production increases in the years coming. We also are doing an exploration program on surface. We have a huge land package, and we've only touched a small portion of it. And so we're doing 20,000 meters this year on the surface. We're planning 50,000 meters next year. Some of that will be underground on the high grade underground deposit, as well as continuing to drill off the surface targets, which can bring in significant mine life and further production increases. And so we also have Lagoa Salgada. So we are expecting an optimized feasibility by the end of the year, an environmental permit as well by the end of the year. That would be put us in a position for the construction decision in Q1. We will do our construction permit and have that by the end of Q2, starting construction in the third quarter next year with production 18 months later in the first quarter of 28. This would bring in about 75 million a year. Again, this was done previously at the previous feasibility study prices. We're updating that feasibility, so you can expect to see those that free cash flow much higher in the updated study that's coming out by the end of the year. Mont Sorcier, we're doing a bankable feasibility study, which will be done by the second quarter of next year. We'll submit our environmental later in the year. We'll complete the project financing. We expect to start construction in the second quarter of 28 with our first production coming in 2030. And while Mont Sorcier is the largest and most capital intensive project, it's the easiest project of all three to actually execute on. And so this one would provide significant free cash flow of about $235 million a year.
Mike, how much of the 20,000 meters have you done so far?
It's a little bit shy. We're probably we won't probably hit the full 20,000 this year. It'll be finished next year. We're probably gonna hit about between 10 and 12,000 this year. When we started the project in the summertime, that was winter in Patagonia or in Santa Cruz. And so they had some problem at the beginning with water freezing in the lines and having trouble doing some of the drilling, but they're ramping up now. So the majority of the drilling will happen over their summer, our winter. So we'll catch up on that, but we are running a little bit behind on that just due to some issues that we had with the drilling when we started. And we also are not as productive with just one drill, which is why we're adding in 3 more drills to ramp that up.
And the other question is this, is the 50,000 meters for 2026 that's planned. When will you have confirmation? I'm sure you're probably talking about that now as we head into the end of the year.
Yeah, so it's confirmed. Like so the budget is set for it. The meters are planned. They have the drill targets. So it's all set up for next year. It's just when we say planned, it's planned in terms of budgeting in the 2026 budget.
Great. Thank you.
So just a closer look at the projects. This is the Minera Don Nicolas project. We have an extensive and underexplored land package in the Deseado Massif. The Deseado Massif is an area which is very similar in geology to the gold fields of Nevada. It's just a lot younger. This area has only been developed for the last 20, 30 years, whereas Nevada has been for the last few hundred years. And so we have steady state production here, as I mentioned, of 55,000 ounces. However, we do expect to increase that. We have 490,000 ounces in the M&I, 121 in the inferred. Exploration has only been on near mine targets. We're starting to step that out with this year and next year's program. And we also commenced underground development in Q2. We actually reached our targets in Q3. So the very end of Q3 saw a little bit of underground. It was mostly development ore, but it's Q4 that is going to see the significant higher grade material come in, and it'll be a much stronger quarter. And as we had guided, the year is back end loaded with that higher grade material coming into the exploration plan. We have a large land package here. It's 330,000 hectares. And just to give you something to equivalent that to, that's about the size of the state of Rhode Island. And so we have the largest land package outside of the government. And so we've only touched a portion of it. So we have a lot of opportunity here to continue to drill. We have some excellent neighbors that have seen significant growth. We have Cerro Moro, which is Pan American, Cerro Vanguardia, which is Anglo Gold. We have Cerro Negro, which is Newmont, and San Jose, which is Hochschild and McEwen. So these are all in the Deseado Massif area, very prolific area. And just in terms of what's around us, you can see by this picture, this pretty much describes it. It's like almost like the surface of the moon. We have our mine, the state highway goes past our mine, the gas line goes by there. We tap into the gas line for power. However, there's our nearest neighbor is probably about 200 kilometers away. So it's a very remote and desolate area. So what we're doing in terms of the exploration is nothing that hasn't been done before. It's a path that's been well trodden. Cerro Vanguardia started in the 90s. I think their first initial resource was about just over 2 million ounces in the 90s. They continued to drill, mostly starting with open pit, which is the beige. Then they added some heap leach, which is the gray area, and then they went underground, and they started to see significant growth once they went underground. And that was built up from a period of 1990 up to about 2020. So they've continued to grow. Newmont, similar idea. They started with about 600,000 ounces. They started underground, and then they went and opened up the open pit. And again, they've grown up to about 6 million ounces. Cerro Moro next to us, which is Pan American, they started with about 600,000 ounces. They're up to about 1.7. However, with Pan American buying Yamana, this is one of their smaller assets, so it's not getting as much attention as some of their larger assets, as when it was under Yamana. However, again, we're in the same district, the same geological setting as our peers. The only difference is that we haven't had the ability to drill it as they have. So we bought this property in 2020. It was COVID. They wouldn't, the Argentinian authorities wouldn't allow anybody on project except for the people that were producing the gold. So exploration came to a standstill, and we're now in a position to get back in with the cash flow and the opportunity to drill that we want to get in there and do some significant drilling. And we believe we can see a much higher mine life of 6 to 10 years at much higher production rates than today. Our target would be to reach that 100,000 ounce rate at this mine. Again, this just shows you the increase in gold. It also shows you the operating costs. So this year we're guiding between 15 and 1700. We have fixed costs at the mine. So as we produce more gold, the fixed costs come down. So in Q3 and in Q4, you will see the all-in sustaining costs drop because we have fixed costs. However, even just looking at economies of scale, we're a much smaller operation than our peers, yet we stay very competitive on our costs. And we think in the coming years, we'll see those costs drop further down. So if gold holds at that 4,000 or higher level, we're making very good margins on our gold production. Just a quick highlight. This is the PEA that was done 3 years ago using a gold price of 2,100. It had an NPV of 111 million, average annual EBITDA or cash flow at 49 million, and free cash flow at 25 million. And yet again, there's still lots of opportunities to expand and to grow this mine. This is where we're taking most of the production up until the fourth quarter was coming from the heap leach operations. They, however, continue to grow and ramp up. Q3, we saw 10,000 ounces, almost 10,500 ounces gold come from the heap leach, which was a record for us. We're investing in some additional fleet capacity, trucks, loaders, and excavators to support higher throughput rates. And finally, we're putting in a crushing circuit that should be completed in the fourth quarter, which also includes an agglomerator and some additional conveyors, which is only going to help to ramp this up. So we should see between 3,500 and 4,000 3,500, 4,000 ounces a month just coming from the heap leach. And then the underground will only add to that because for every ton of ore that we take from the underground, it's at a much higher level. That will go to the CIL plant and will replace the lower grade material that's going there. The lower grade will still go to the heap leaches. However, that is where we find the biggest opportunity to ramp up our gold production. This is the open pit at Minera Don Nicolas. It was called the Paloma pit. You can see in the white here, this was the original open pit. It was designed at $1,700 gold. If that was designed today, it would be much deeper and much longer. However, as you can see from the picture here, it's fairly steep. So to push back the pit walls would be very expensive and uneconomical. So what we're doing is we've ramped in 3 different spots from the bottom of the open pit. We're mining the area just below right now. That's what's coming in starting in the fourth quarter here. However, we also, when we are done the drilling, are setting up drill platforms here underground so that we can drill off all of the extensions on a long strike here because everything's open. And so this has been typically as high as 16 gram material, 8 to 12 grams tends to be more the average. However, again, we have nice wide vein widths here. So this represents significant opportunity to expand and grow the mine life as well as increase production at the project. This is the surface plan. We have multiple targets here along a 10-kilometer strike. You can see the targets here. We've already done drilling at Reyna, Sulfuro East. We're in number 3 here, which is the north extension. We've seen some initial good targets from these areas. You can see here, we did one area that had a meter at 15 grams. We also had 3 meters at 6 grams, including another meter at 30 grams. And so this is just some of the targets and some of what we're seeing here. So we know there's very good opportunities here on surface to find more material. And so we'll continue to drill on that.
Hi,
Beyond Rick,
excuse me, Mike,
sorry,
what is going to be the target in 2026?
target in terms of meters or target in terms of
No,
what?
target in terms of the area you're going to be drilling.
So in 2026, we're going to be continuing to work. So this is the 20, sorry, get my right slides here, right? This is the 20,000 or the 20,000 meter program. So this will get completed. However, there will be some further drilling based on the success we've had here. There probably, I would say, area is going to see another, 10 to 20,000 meters of drilling underground. Drilling out the extensions here is probably going to have about 20 to 25,000 meters, and then we have some other reach out targets. So this is one here, Paula Andrea, which is a little bit further away from the mine. We mined originally these high tip fingers. It was very good grades. We were getting in the 40 grams per ton. We had a deep hole here, which was 12 meters at 122 grams per ton silver or gold, sorry. And so this is another area where we'll drill probably 5 or 6,000 meters next year. And longer term, we may even reach Chispis, which is this area here, which is online with Sarah Morrow's Natty discovery, which was very high grade gold. And this is about 3 kilometers, but it's the same gold trend. So this is another target that we have if we can get to next year. But this would be probably the third target. Moving on to Lagoa Salgada, which is our VMS project in Portugal. We own 80% of this project. We completed a feasibility study about 2 years ago to complete that ownership earn-in. However, it had to be done in a bit of a hurry to get that, meet the timeline and get the ownership. So we are repeating that and we'll publish that by the end of the year. And I will talk more about it on a slide coming up, but we've done substantial work on the metallurgy and other things, which will significantly increase the economics of the project. But even in its current state, this project adds 40% gold and silver, 27% zinc, 15% copper, 7% tin. All of the critical minerals are in demand in Europe, and the metal prices have gone up for these significantly. So again, this will see very good cash flow coming from this. Because zinc is the highest metal that comes out of this project, we have to use that when reporting our quartile costs. And so we're reporting 59 cents per pound for the first 5 years, 79 cents for the life of mine. I'm just going to jump down a slide here because there's a cost curve here of every zinc or zinc equivalent producing project in the world. 59 cents, which is the initial 5 years, is at the very bottom of this cost curve. And 79 cents for the life of mine is still well within the lowest quartile. So again, very competitive, very low cost mine in this area. We're fully funded to construction on this. We, as I mentioned, expect to have our environmental permit and our updated feasibility by the end of the year. If they come out at the very end of the year, we may wait till the first week in January to publish those, just to wait till everybody's back. However, the approval, RICAPE, which is the construction permit, we expect to receive in Q2 and start construction in Q3. The project is really well located. It's here located in the north end of this orange band, which is the Iberian Pyrite Belt. We're about an hour and 15 minutes from the capital of Lisbon. We're less than a half hour to two different ports. We have the national rail line runs right past our project. So the infrastructure in this area is fantastic. And so we're, in terms of expenditures on infrastructure for the project, it's pretty much contained just to the project itself. Again, you can see the breakdown here of the metals. 40% is going to be gold and silver. And we do have some zinc, tin, and copper, which are critical minerals high in demand in Europe. We had EBITDA of 75 million on the project. The new project is coming out. I think you're going to see a significant increase in this project on that. And we do have a very large resource here. So overall, there's about 30 million tons of resource, and we've only done about 40,000 meters of drilling. So the ratio of resource found to meters drilled is excellent. So it's a very prolific area for drilling. In terms of the time, go ahead.
Someone is asking, can you discuss who the 20% owner of Lagoa is?
Yeah, it's a company out of or it's a fund out of London. It's called MF&I. Jacques Vancourt is the person. He actually brought us the project. Originally when they owned it, we had an earn-in opportunity, so we did the drilling, the feasibility studies to bring in our ownership up to 80%. Now, the government of Portugal has an opportunity to back in for 18% of the project. And so the way it's structured is that if they decide they want to back in, it comes from their 18%. So our ownership will never go below 80%. And a lot of times what happens is the government prefers to set up a royalty versus ownership. And in that case, we can likely end up owning closer to 95% of the project. So yeah, there's significant opportunity to increase our ownership. The other group that was working with us, they're just business people. They're a fund. They wanted to see the project developed, but they're not operators.
Great, great, thank you.
Timeline to progression, as I've already shown. So the updated the updated feasibility study will be by the end of the year. The environmental approval we actually expect to get at the end of this year. So we're actually ahead of schedule on that. The construction permit we expect in Q2. Finance discussions are ongoing and going very well with strong support from UCAF and Banco Santander on the 70% of the construction financing through debt. And I'll talk more about that in a minute. But then we also expect to start construction in Q3, 18 months of construction with production taking place in the first quarter of 28. The one thing I forgot to mention, the symbol here just reminded me, is we're a project of national interest in Portugal. And so to get that, you had to have buy-in not only from the federal government and the environmental agencies, but also the local community, the mayor, everybody. And so we were the first mining company in Portugal to ever receive this designation, which has helped us to speed up our permitting processes and also has strong support for the project. So there's not a lot of pushback. And so it's somewhat of a fast track for the project to get built.
So you think that timeline, you're pretty confident you'll stick to that timeline?
Yeah, like I was mentioning, originally, according to the timeline, we should have got this permit in sometime in Q1 when we think we're going to get it before the end of the year.
That's great.
So,
yeah.
So when I mentioned that we updated the feasibility study, we did significant work on metallurgy. That's the biggest change between the two studies. We've targeted higher increased recoveries, so we've managed to improve the recoveries. We're able to produce higher concentrate grades and reduce the penalty elements, which means we'll attract a higher NSR, net smelter royalty, per ton of material produced. Because we're using higher metal prices as well, we're able to include significant more resources into the study. Probably, if I'm guessing, we're going to see at least a 30% increase in the resources. The initial capital, we worked with a guy named Guy Lozer, who built Neves Corvos, who worked on Aljustrel, who also worked on Aguas Tenidas. He's an expert in the area. He's helped us to optimize and to reduce the capital and equipment required. So we've seen an initial capital decrease probably from 165 down to about 150. So we've seen savings there. We've also improved the design processes, and we've moved to dry stack tailings, which are easier, more environmentally friendly, and easier to manage. And so that's saved us costs. And also we were looking at what the ideal throughput would be for the mill. And although it's, the original study looked at 1.2, we think this study will see around 1.5, 1.6. However, there's significant opportunity from exploration on the belt that if we continue to ramp up the grades, we can look at expanding the mill and producing at much higher throughput levels. The mineralization in the Iberian Pyrite Belt tends to occur in clusters. And so you can see Aguas Tenidas here started with one cluster, and they continued to add. Neves Corvos started with the Neves and Corvo clusters, but they've continued to add. They use deep penetrating radar, which is how you find a lot of these deeper clusters. That's how Lombardo was found as well. The European Union did something called the Undercover Study. It was a 3 billion euro or 3 million euro study between the universities and several mining projects trying to expand exploration in their areas, and that we were luckily enough to receive about probably 60% of the funding for work done on our project. And we know that we found through that multiple other targets here. So we knew there was a cluster here that confirmed it, but it looks like we have other clusters here and other clusters here and some further down. So we're very excited. Part of the funding package that we have for this mine is another 25 million to complete an exploration. And so that, as we're going into construction, we're going to continue to drill the property, and we can expand the mine life and potentially look at expanding the throughput on this project to be a much higher value project. And so what I was saying is that on the anomalies, we have 1.7 kilometers that we're drilling and working on right now. However, the anomaly for the project is 8 kilometers. And so we've only worked on a fraction of that. So there's still significant growth potential for this project at depth and along strike. Finally, this is our Mont Sorcier project. This is located in Chibougamau, or close to Chibougamau, Quebec. And so the thing that's amazing about this project is the infrastructure is already there. Most iron ore projects are located out of the way, and they typically have to spend like $1 to $2 billion on infrastructure to bring their product to market. The thing we're lucky about, this is the project right here, 11 kilometers away. There's a railhead in Chibougamau that has 370 kilometers of rail. That's Canadian National Rail, government owned. And so it's only operating at 30% capacity. So we've secured capacity for our product on that. Also, the Port of Saguenay, the government has spent $300 million. They actually just earmarked another $75 million in the last budget to develop and expand this port. What they're trying to do is open up the James Bay region. So you can see here, James Bay is here, but north, if like off this map, there's significant amounts of critical minerals, rare earths, and minerals that are deemed to be very necessary to society. So they're spending a lot of money in terms of upgrading the infrastructure and getting this ready area for additional projects that will come on to the north. However, right now, they don't have a customer yet, and we will be their first customer. We've already secured our space at the port. So in terms of that, we probably saved about $2 billion in infrastructure costs. The only thing we need to build is a rail spur to the railhead. Probably, I would say that's going to be somewhere between 10 and 20 kilometers worth of rail. However, that the infrastructure cost for that is well below what it would have cost to get rail all the way to the port here. And so that cuts down on permitting time as multiple other things as well. You can see the site here. This is a road to the site. This is Mont Sorcier. The iron ore is right below that. So the strip ratio on this project is less than, it's about 0.5 to 1 because we go right into the project. The other thing is that we completed a PA on this project in 22. The thing what we were looking at was 65% iron. Since that time, through testing, we've proven that we can get to 67% or higher with very low silica and aluminum combined. And so with this project, you know, as I mentioned, we'll see free cash flow of $235 million a year for 21 years. That was using 65. So it's likely going to be higher with the 67% concentrate on this. When you look at the project, we were looking at 5 million tons, total cash costs of $26 a ton, all-in sustaining $28 a ton. We looked at sending it to China because every iron ore project does the same thing because China typically was the taker of the iron ore. However, with this high purity iron ore, we're seeing a lot of demand right here in North America, as well as Europe and the Middle East. So our cost to ship will be much cheaper. So we're probably looking at an all-in sustaining cost of about $45 a ton. Just to give you an idea of margins, the 67% iron is selling for about $135 a ton. So very good margins on the iron ore for this project. And so very short payback period and very good IRR, 43%. We recently put out a press release letting the market know that we're going to be expanding this project in the feasibility study through stages. So instead of looking at 5, we're going to be looking at 8 million tons of annual throughput. However, it's going to be done in stages. So it'll be 4 million in the initial stage, and then 3 years later, they're going to add another 4 million tons. And the idea here is that the initial stage will be probably about 800 million. This is a guesstimate number. This is like there's nothing backing up on this. This is me telling you my own guess, about 800 million. And then the subsequent amount would be about 400 million. But the good idea here is that the cash flow from the project and the initial cash flow would pay for the second extension without any further dilution to shareholders. But even with it, right now we are looking at about 600 million in the initial study. We know that that's going to grow through innovation. So even at 800 million. We're not worried about that. We're going to have higher grade, which is going to attract more costs. We are working with in Canada, TD Bank and UCAF are backing the project for 70% of the project financing. We also see off-takers wanting into this project. So the amount of capital raised will be de minimis to put this into production. So there's a lot of upside here for minimal dilution to shareholders. Sorry, go ahead.
Just one of the questions. How did you come to own Mont Sorcier? It seems like it's not part of your like a precious metal strategy. I think you just answered, will you fund it alone or look for a JV? But can you talk about the history and how you came to own it?
Sure. So it's a pretty simple thing. It was Voyager Metals was the name of the company. They sat in the same shop as us. We shared office space with them and Ascendant Resources. There was three companies sharing office space. They were not getting the love that they deserved for the project that it is. It was hard to advance it. So Sierra picked it up at a very low valuation and has been able to advance it to where it is today because they had the cash flow to do so. So again, I guess this kind of brings me to so what happened is they brought it in-house to help it keep it alive and to fund it to its next stage. And this brings me to the next question is, what are we going to do with it? Once we finish this feasibility study, the board will then review the project. We do have the ability to build it. We have the technical expertise. We have everybody in-house. We could essentially build it and probably do it alone. However, there's good opportunity here to look at joint ventures. We have many of the steel mills in North America and other iron ore producers that are very interested. So we may joint venture this, and we could potentially even sell it for a significant premium over what we paid for it and what we've invested. So there's a lot of opportunity here. I can't give you a final answer as to what's going to happen because the board will decide on that probably late next year once the feasibility study has been completed.
Yeah, great. Thank you.
What I can say is that we have a huge resource here. We have over 1 billion tons of resource, and there's that's only probably on about half the ore body. There's still a lot of opportunity here to continue to drill and expand this resource. The other thing is that the original PEA study done was only on a third of this. So there's still lots of opportunity to extend the mine life and to have this be a generational project. And so looking at the project from resource and grade, sorry, my mouse is being tricky. From resource and grade, Voyager sits here at 67% iron ore. The highest one is black iron, the Shimanivsky project, which is located in the Ukraine. They have 68%. However, this is the Donbass region, which has taken a lot of war casualties in the Ukraine. And so I don't think this is going to be built anytime soon. So again, we have one of the premium projects out there, again, in terms of the ability to produce a high grade concentrate with low silica and aluminum. And so while you think, you know, what's the difference? The iron ore producers or the steel producers, even here in North America, want this not only just because it's a greener steel and it lowers carbon emissions, it has a higher burn rate, so they need less coal. It's cheaper, it's easier on their furnaces. So it's actually, you need a lot less of a product going into the furnace for the equivalent or the same output. And so it helps to save them money and it helps them to operate more efficiently. So they would typically buy this higher grade material, blend it with lower grade material to help keep their costs down and to take it easy on their furnaces. So this is a product that's going to be in demand for generations to come. Looking at the balance sheet again, we have 14.5 million, probably be closer to 20 million by the end of the year. We have the opportunity to bring in another 15 million through a land sale that was completed, and we'll get the 5 million and 10 million through option agreement with Anglo Gold, which is looking very attractive and about to become a reality. The other thing is that we have free cash flow. Again, we're saying 25 million because that's what we put in our feasibility study. But again, that was at $2,100 gold. So just doing simple math at $4,000 gold, you can pretty much double those numbers as to what we expect from cash flow and free cash flow for the project. Again, a lot of people ask, how are we funding this? So what we did is when we had these projects, we went on and shopped them to all the export credit agencies. We went to the Canadian, US, Britain, Norway, Germany, Sweden. There's multiple export credit agencies we went to. Export Credit Agency of UK or UK Export Finance, UKEF, came back with the most aggressive terms. They're willing to provide 100% guarantee on the project. So they wrap the project in a guarantee. They guarantee the finance risk, the building risk, the interest, everything. In turn, they ask for 40% of the content that you use to build the project to come from UK sourced goods. So engineering services, consulting services, lab services, any kind of like projects. The other thing that's interesting here is, say we want to buy some mezzo crusher or equipment. Although mezzo is not made in the UK, they do have a service or a dealer there. So as long as we buy it from the dealer in the UK, that counts against it. So very flexible on the content requirements. And so what happens is they then come in and are able to guarantee this. And so that's for 70% of the project financing. So in Portugal, it's Banco Santander that will lead the syndicate of debt arrangers. And in Canada, it's TD Bank that is taking this on. And even though it's earlier in the stage, the project meets their mandate and they really like it. So they stepped up very early to put their name in. So they'll be backing the syndicate here in Canada. So 70% of the project cost is already covered. The other 30%, they're very flexible as well. So if we wanted to bring in a stream, Sprott has already shown interest, especially in the project in Portugal, to come in for another 40 to 50 million. I'm not sure if we're going to let them put that much in. If the equity price is higher, we may raise a little more equity versus giving it away through a stream. We also have offtake agreements that we can bring in here. So to meet this 30%, if you have between the offtake and equity, it lowers the amount of capital we need to raise significantly. So although this project in Portugal all in would probably be a $200 million raise, the equity component could be as low as 5 to 10 million. So it's a very low equity raise, which keeps the dilution to a minimum if we need any at all, because we also have our own cash flow from production in Argentina. So again, the capital equity need could be de minimis. Who's built these projects? So we also have the team has been together for about 25 years. They started with the Jacobina mine in Brazil. It was in care and maintenance. They paid $2 million for it. They took it out of care and maintenance. They drilled the project, ramped up the resources, put it back into production, ramped up production. 4 years later, they sold it to Yamana for about $600 million. This is still one of Pan American's best mines operating today. They then went on to Largo, which was cow pasture. They completed the drilling on the project. They put a resource on it. They took it through the PEA and feasibility studies, through construction into production. And so it's from a market cap of 10 million when they got involved up to a high of 2.5 billion, which when Mark and several others left the team to go on to other opportunities. Sierra Metals, Mark came into, it was a troubled mine. It had water issues in the underground. It had a low resource. Mark came in, took part of the mine offline to fix the water issues, put in a significant exploration program, ramped up the resources on the property, and also spun off a non needed asset that was just costing money. At the end of the day, he managed to see a 2.5 times improvement. The shares went from about 80 cents up to closer to $4 in the under 2 years that he was there. So we have a very strong team. We have very strong people at each of the mines. While Mark sits here and we have engineers and geologists here at the corporate office, we also have strong people, including João Barros, in Portugal. He's got over 20 years working in the mining sector in Portugal. He works with a guy named Guy Lazon, who's an engineer with 30 plus years experience, who's built multiple projects there. So we have the right team in place that don't require a lot of corporate resources to move the projects forward. We also in Quebec have Hubert Vallée. He worked on Bloom Lake. He helped to build it. He was critical in that construction process. And the team that he has working with him in Quebec are very solid. So again, it reduces the amount of work output required by the corporate office. So very strong technical teams in place at each of the mines. Looking at the capital structure, share price on average about $1.39 right now, 135 million shares outstanding, 150 fully diluted. We have a market cap Canadian of 188.2, and then that's a cash position of 14.5 million with another 15 million coming in. And even beyond that, we expect just the cash position through cash flow from Argentina to increase to $20 million this year. We do have research coverage from H.C. Wainwright, Heiko Ilhe, has a target price of 210. Ron Stewart of Red Cloud, he just took over from the previous analyst, so we're under review at the moment. In terms of ownership, management and the board have about 11%. We have institutions, CQS out of London owns about 3%, but we have a smattering of other groups that own like, under 1%, up to about 1.5%. So about 14% institutional ownership. So still leaving us with a rather healthy free float of 75%. We'd like to see that come down to a free float of about 50%, get a bit more institutional holding. And that's where our focus has been on other marketing this year, is to try and bring in some other funds, especially as the market cap and the project improves. We're getting onto a lot more people's radar. So finally, where are we today and what are we? We're a steady state gold producer, 55,000 ounces over the next 4 years. However, with the exploration that we're doing, we think we can ramp that number up as well as extend our mine life. We are cash flowing. Today's gold price is closer to 100 million cash flow, 50 million free cash flow. So definitely adding to our balance sheet. It was an extensive year this year in terms of development funds that we paid in Quebec and in Portugal. However, 2026, those numbers drop significantly. The capital burn will be much lower, so we'll start to build cash at a much higher rate in 2026. Lagoa Salgada, as I mentioned, we're working through that now. We'll see the environmental and the feasibility study update by the end of the year. We'll be in construction decision by Q1, construction by Q2, and construction Q3, and production in 28. And Mont Sorcier, longer term. However, we will complete a feasibility study by the end of Q2, which could represent a significant improvement in valuation as we lock in that value. As well, as I mentioned, we're not sure what's going to happen with that. We could take on a joint venture partner. We could sell it. We could build it ourselves. I can't tell you exactly what's going to happen. The board will decide that likely next year. But we are well funded to our construction. We haven't raised capital since our IPO. So, the group has done a very good job managing funds and keeping the share count at a lower level. So with that, I'll turn it back to Anthony if there's any other questions.
Yeah, there are a bunch of questions in queue, and if you have a question, please feel free to type it in to the Q&A or chat box, and we'll make sure it gets answered. So, did you touch on earlier, Mike, how the all-in sustaining costs are going to slowly decrease at Minera Don Nicolas?
Yeah, I did briefly, but yeah, so the rate this year we guided, I think, between 16 and 8 or 15 and 17. So on the higher end, the beginning of the year, we saw higher costs because the production levels were lower. And so we have fixed costs. So those fixed costs have to be divided by the number of ounces. So as we worked through the year and the ounces increased, the third quarter was better than the second, and we expect the fourth quarter to be a step change over the third quarter. And so as we are producing more ounces, those fixed costs have more ounces to be divided by, and so we will definitely see lower AISC in the third and fourth quarter and going forward.
That's great. Question about analysts. You mentioned Heiko from Wainwright is following you. Red Cloud is reviewing it now. Any options in the money?
We do have a few options. Most of them are in the money. Most of them are longer out though. They have vesting dates on them, and some of the vesting doesn't happen for another year yet. So they are in the money, but and so people will likely wait to vest those just to see what happens with the share price. And then the warrants, we have a very de minimis amount of warrants. They are in the money, and those could come in by the end of the year, early next year.
Okay, great. Has the board discussed an uplisting to NYSE American or other exchange?
Yeah, we're definitely looking at that. So the thing is to get to the NYSE American, we need a share price of $3 US to get to the Amex, or not Amex, it's NASDAQ. You need it's $4 US, and so they are looking at potentially lowering those prices. I've been doing some reading on that to make it a little bit easier, but so where we are right now is we're hoping that as we move the story forward and our market cap improves, and the share price improves, we can do that. We would be willing to do a rollback. We don't want to have to do a major rollback because we would be bringing the share count down to about 70 million right now, and we're afraid that would affect the liquidity too much. So we are definitely interested in it because there's a lot more liquidity on the U.S. markets. I know this from previous companies I've worked for. So it is on our radar. We're watching it, and we're hoping that with the news coming in the next little bit and all the deliverables, we should see a higher market cap, in the first, second quarter next year, and we could start to look at an uplisting to the Amex or the Nasdaq.
Great. Why did the company sell Monte de Carlo? Any regrets by management?
So yeah, of course we regret it. We didn't want to let that go. It's an amazing project. It would have a huge valuation today. What happened is the project in Argentina was funding the development of the Monte de Carlo asset. At the end of end of 23, early 24, we were trying to raise some money to bring that project to the next stage. The market just wasn't open at that time. And then to compound that, what ended up happening is that's right when Milei came into power in Argentina, and we saw the inflation rates go through the roof. And so operating lines of credit, 30, 60, 90 days disappeared. Everything was cash up front. It put a significant strain on the balance sheet. And so, management with a heavy heart sold that asset to Hochschild. Not something they wanted to do. We really love that project, but it let us live another day. It cleaned up the balance sheet and helped us to have the cash flow to build these other projects that we have and develop them. And so while we lost what we lost in value there, we think we will gain not only through the exploration, but also the putting Lagoa Salgada into production. So whereas that mine, we had a mining life year of 10 years there. They've been doing a lot of drilling, and it doesn't look like they're going to be able to extend it. So it looks like that's a finite mine life on that project. Whereas Lagoa Salgada and the projects we have, we think the mine lives can go well beyond that.
Yeah, and I think it really transformed the core assets that you have here, and really, like you said, tightened up the balance sheet. So I think at the end of the day, it was the right thing for the management team to do. Will your significant excess cash from operations and asset sales lead management to potentially announce a dividend, maybe a special dividend, or is all the money going back into the business?
In the near term, I think a lot of it's going to go back in to minimize dilution. However, a longer term, especially as we start to have significant cash flow, there'll definitely be dividends going back to shareholders and repayment of shareholders.
Great. Um, this is more of a statement, but you can add to it. Based on current valuation, the market doesn't seem to factor in the potentials of the other projects outside of Minera Don Nicolas.
No, so this is a good way I like to tell people to look at that, because I've had a lot of people ask me, like, you're kind of where you are now. Are you going to see any additional valuation in the near term before these other projects to get to construction? So if you look at this, if you look at our comparables in terms of gold production, like who's producing similar number of ounces. So you look at Serabi, Heliostar, Minera, Alamos, Jaguar. They're trading at about 200 to 300 million more in terms of market cap than us, but yet their production levels are about the same. The only difference is they have longer mine lives. And so I think as we can show through our exploration program growth in Argentina of our mine life, I think we could see an immediate $200 to $300 million lift on the market cap. If you look at Lagoa Salgada, with the feasibility study coming in, let's hope it's, and I'm going to put a number out there. Let's say 190, 200 million. Canaccord's showing right now for base developers a PNAV average of about 0.55 times. So if you take, let's say, 200 and multiply that by 0.55, you get US 110 million or Canadian 150 million. So that's an additional immediate increase when that study comes out. And then Mont Sorcier with the NPV coming out, like if you look at this, when we put out the updated feasibility study, we expect the NPV to stay the same, even if we use a very conservative 0.1 times. That's 160 million US or 225 million Canadian. So if you add those all up, you could see in the short term, even before these projects get to production, an additional 500 to 600 million of Canadian, probably about 400 million US of valuation added to the market cap.
Absolutely. Couple more questions here. Does the company have any debt?
Yeah, the company does have debt. So we have operating lines of credit which is working cash flow in Argentina. That's about 10 million. That will always be there because it just continues to turn over. We did have payable debt of about 30 to 40 million. That will be paid off by the end of the year. For all intents and purposes, there might be a couple million left, but and then the other thing you'll see if you're looking at our balance sheet, you'll see like a 20 million debt line, and so that's the stream that currently exists on the project in Portugal. That's not something we will ever pay back. It converts to a stream once we go into production, but for now it sits on the balance sheet as debt. But in terms of payable debt, we had about 30 to 40 million. That will be gone by the end of the year for all intents and purposes.
Great. A few more questions here. What have you seen as the major difference in the Argentinian economy, i.e., costs and government interaction?
Sorry, can you repeat that, Anthony? One of those 9/11 alerts just went off on my phone, and I missed what you said. Or those
No
Amber
problem.
alerts.
What have you seen as the major difference in the Argentinian economy, i.e., costs and government interaction?
Sure. So for the most part, costs have come down. In talking with the locals, their groceries are coming down. A lot of cost of living is coming down. The inflation rates have reduced significantly. Malay just got elected or got through to another term, so he's able to continue his initiatives to continue to reduce the debt in country to rebuild the economy. The other thing he's done for us as a mining company is he's gotten rid of the repatriation of capital back to country. So when we sell our gold, we used to have to return any gold that we sold back into the country within 180 days. That's gone now. So any gold we sell, we ship it out to be processed, and the profits come back here to the corporate office in Toronto. We only send cash calls down to the country to deal with expenses or whatever we have. But operating in country is much better. You're seeing that now. You're seeing investments coming in from McEwen and others who wouldn't do these investments if they didn't believe in the future of the economy there. So while some people still don't like Argentina, it's head and shoulders above what it was, and it's becoming a very attractive investment jurisdiction.
Absolutely. As you ramp up to achieve cash flow anticipated by 2030, can you provide what the percentages of that cash flow will be among your assets? Is that on a previous slide, I believe, what your projections are going to be?
Yeah, so this is using the feasibility studies. So you got to remember that they're going to be much higher. But you look here. So for example, 44 million of cash flow. This is at $2,100 gold. So obviously this is going to be closer to 100. Lagoa Salgada is adding about another 90. But that again, it was done. I think the gold price was $1,700 gold when it was much lower. So, but using conservative numbers, you can see here by 27, we would be at 112 million. Realistically, that number is probably going to be double. And then by 2020 or 2030, we're seeing 366 million of cash flow from Mont Sorcier. That brings us up to 500. And if at today's metal prices and where we are today, that would be probably, I'd say, at least 30% higher. So, but yeah, you can see the cash flow build up here throughout the years, done at conservative metal prices.
Absolutely. Great. Last question. Do you see possible opportunities for us for Cerrado in South America as a mine operator in South America? What countries do you view as good jurisdiction for natural resource investors?
Yeah, so we still have our team that worked in Brazil. Some of them are working with us in Argentina, but the rest are still looking for projects. So Brazil is a great jurisdiction. We really like Brazil. Argentina, we would look at now. We also like Chile. Even Bolivia has come a long way and is a lot friendlier. But pretty much anywhere in South America, Peru, we like all of those jurisdictions. We have a strong team down there. We are looking for projects. We review tons of projects. We turn down a lot of projects. I think we're looking more on the precious metal side versus the critical mineral side. We would like to expand the precious metal throughput, and we have seen a few opportunities. I can't say too much more about that until they're public,
Yep.
but definitely we have our eyes open and we're looking.
Yeah, great. And you're in a great position potentially to make an acquisition as well. So that's just, obviously it has to be the right opportunity, but glad to see that management is has boots on the ground looking at different projects. So that's great. That's the last question. We're going to leave it there. I want to thank Mike McAllister for coming on and bringing everybody up to speed on Cerrado Gold. It's definitely the right time to be looking at the company, especially with the positive outlook for precious metals and the progress being made at all the properties that they have. Remember, you're going to have Lagoa Salgada come online soon, ramping up production also at Minera Don Nicolas. So, there's I personally don't think that the market is valuing the potential of the other two companies, excuse me, projects. So it's time to really take a long, hard look at this. And it sold off a little bit with everything else in the market. So I think it's a really good entry point for those who are looking at the stock. Before I wrap it up, Mike, any parting words for our viewers?
No, just agreeing with you, Anthony. I think they're even in the short term as we continue to de-risk the project and we bring in feasibility studies and permits on the project. You know, if you look at the life cycle of a junior company, typically those are all value accretive milestones. And so I think as we reach those milestones in the coming months, we'll be able to see further value accretion in terms of market cap for the shareholders. Longer term, we have significant cash flow coming online. So again, I think whether you're looking at it now or long term, there's definitely opportunities for value accretion along the way. And I think, as you say, we're not really receiving those right now in the two projects that are in development.
Absolutely.